Hello there. This is Larry Pond. I'm a CPA and certified financial planner. Today, we're going to talk about Proposition 19 and the question, should I transfer my property now? So let's talk about the tax consequences. If I transfer my property to my children now, instead of waiting until after I pass away, what tax consequences do I need to be aware of? Well, we got to think about the property tax consequences, the income taxes, the gift taxes, and estate taxes. We have many different kinds of taxes to consider, and every action you take will have a different impact on these different kinds of taxes. So, first, let's talk about the property tax consequences. So, property taxes are based on an assessed value of the property. Now, that's not the same as the market value of the property. So, sometimes you might have a very low property tax assessed value versus what you can sell the property for. Now, Proposition 19 was recently passed by the voters of California in November of 2020. So, one way to circumvent the changes by Proposition 19 is transferring the property to your children before February 16th of 2021. And then there will be no reassessment of property tax value upon death. So, under the current law, before Proposition 19, there are two exclusions for reassessment that can apply for transfers between parent and children. So, we have the principal residence exclusion and the $1 million lifetime non principal residence exclusion that allows a transfer between parents and children of up to $1 million of assessed value of all other types of property. So that includes second homes, vacation home, or rental properties. So in the case of a married couple, there would be a $2 million lifetime exclusion. So what did Proposition do? Well, Proposition 19 applies for transfers on or after February 16th of 2021. So in order to qualify for the principal residence exclusion, the receiving child must use the residence as their own principal residence. And only the first $1 million of additional assessed value is excluded. And the non-principal residence exclusion has been completely eliminated. However, there is a exception for transfers of family farms. So the principal residence exclusion will still apply to transfers of family farms. So transfers that occur before February 16th, 2021 will not be reassessed after the new law is enacted. So we get the property tax considerations. What about the income tax consideration? Well, if the children are likely to sell the property after they inherit it, if you transfer it before death, you're going to eliminate the step up in basis that the children would get if they inherited the property at the parent's death. So you might want to consider, if the children are likely to keep the property, are they going to use it as a principal residence? Are they going to convert it to a rental property? So you need to evaluate the difference in the step up in basis versus preserving the property tax base. So let's go over this example here. So let's say the parents have a primary residence and the child will make the property his primary residence. So in our example here, the tax base amount's $500,000. And to make the math easy, the cost basis is also $500,000. At the time of the transfer, the market value of this property is $1.3 million. So we take the market value minus the tax base amount. So 1.3 million minus $500,000 equals $800,000. So since the $800,000 is less than a million, there's no reassessment upon transfer. So in this case, the child's tax base is still $500,000. Let's say the child just turns around, sells the house. So he's going to have to pay a capital gain of $1.3 million minus the $500,000 cost basis equals $800,000 of capital gain. So if you transfer the house now, you're going to have this $800,000 capital gain. Let's say the child waits a couple of years. You wait 2 years to sell the house to take advantage of the $250,000 exclusion from gain. So you have 1.3 million minus 500 minus 250. So if you waited 2 years, instead of paying tax on $800,000 of capital gain, you pay tax on $550,000 of capital gain. So let's continue this example here. And instead of transferring the property to the child now, we wait till the parent dies. And so the child inherits the property. So there's no change in property tax base because the child moves into the property and uses as a principal residence. The child decides to sell the property after inheriting it. So the capital gain is 1.3 million minus 1.3 million because the basis has been stepped up to the fair market value. So 1.3 minus 1.3 equals zero capital gains. So that's a big difference from zero and $800,000. So waiting up to inherit the property instead of taking it now, you can save quite a bit of money on capital gains tax. Let's say the child doesn't use his home as a principal residence. It becomes a rental property or something like that. Well, the property tax base could be reassessed to market value, which would be the 1.3 million. So after not only the income tax consideration, there's the gift tax consideration. So the parents are transferring the properties to the children now. You need to consider the gift tax. There's the $15,000 per donee annual exemption. So if you give less than $15,000 to each person, there's no gift tax consideration, no gift tax filing. The lifetime exemption, also known as the basic exclusion, for 2021 is $11,700,000. So for a married couple, that's double that, $23,400,000. What that means is, as long as your total gifting is less than the basic exclusion, there's no gift tax to be paid. However, it needs to be reported on Form 709. So you can take a look at Form 709 and read the instructions very carefully. So here's an example of the gift tax. The parent gives the child the home. So report that on Form 709. So the gift is $1.3 million, less the gift exclusion of $15,000. So the gift tax, the taxable gift is $1,285,000. There's a credit against the basic exclusion. So 11,700,000 minus 1,285 equals $10,415,000 remaining basic exclusion. The bottom line is the gift tax is zero. So let's talk about the estate tax. What's the difference between a estate tax and a gift tax? Well, the gift tax applies when the donor is still alive. A gift tax is when the donor is deceased. So that's the difference. They're both a transfer tax. It's just depending on the donor, alive or not alive. So let's say the parents hold on to the property and pass it to the heirs upon death. You might need to consider the estate tax. The basic exclusion is $11,700,000. If your assets exceed this amount, the current tax rate is 40%. Now, the way the law is written today, on January 1st of 2026, the basic exclusion amount will be reduced by half. Under the new administration, that might happen sooner. The form to file for estate tax is Form 706. That's filed after death. Now, if there's two spouses, upon the death of the first spouse, you might consider filing Form 706 to take advantage of what's called portability, which means using the deceased spouse unused exemption. So that's something to consider to add that to the surviving spouse's exclusion. So in conclusion, you need to evaluate the property tax savings versus the capital gains tax. Review your estate plan, get it up to date. The laws are constantly changing. Update that. And also consider the non-tax consequences of transferring property or adding children to the title of property. Are they responsible? Is this going to cause a family rift if there's unequal distributions among family members when you're still alive? I've seen cases of children losing the homes that have been gifted to them from their parents. And always consult a knowledgeable and experienced advisor to help you review all the variables. We want to look at the big picture, not just one specific little detail. So considerations to think about is, do you have a low property tax base in relation to the current market value of the property? Does your family want to hold it for long term? Or do you have a vacation home that might stay in the family for many generations? Or maybe your family members have no plans of keeping the property after the death of parents. What if you have rental properties, a commercial properties, an apartment building, different types of rental properties have different considerations to think about. And how's the estate to be allocated among family members? Are they sharing everything equally, or does one heir get one house, the other gets another house, or the other gets investments? A lot to consider. But we also have a lot of questions too. When the proposition was passed, there are some unanswered questions we need some help with. What happens if the property converts to other uses in the future? What if there are multiple children? Do they all have to live there together? Can one of them live there together? Should I transfer my property to an irrevocable trust? Should I transfer my property to an LLC? Lots of considerations to think about there. The California Assessors Association has some questions because the assessors are the ones who have to implement this law, and there's some unanswered questions. They're going to need some guidance from the state agency that's administering this. It might be answered through future legislation, follow-on legislation, or we might even need constitutional amendment that's approved by voters. Yes, you might see another proposition in this matter to resolve some issues and questions. So I hope this was helpful. Thank you for your time. And if you have any further questions, you can reach out to me here. Well, thank you for your time and have a great day.